To understand the economy, you have to understand human nature.
This podcast is powered by Acast.
How you doing there? It is time for the podcast. It is the dog days of summer. People are on holidays. People are not watching what's going on. People are distracted. But what is going on is a significant number of issues in the global economy, which may well change the course of politics, economics, and unfortunately geopolitics over the next 5 years. Why? Because we're going to look at the American economy today. What's going on? Is the glass half full? Is the glass half empty? And we're doing this against the background of financial markets worldwide waiting to see what the Federal Reserve will do. Will it cut interest rates? Will it keep interest rates where they are? If it does keep interest rates where they are historically high. And that has huge impacts on commercial property, on exchange rates, on stock markets, all of which have what they call, in the jargon, a wealth effect, which will trickle down into the real economy. So that's what we're going to do. We're going to do, John, we're going to get inside the head of the Fed, okay? The Fed heads, Jerome Powell, we're going to see what's going on in his world. And again, what triggered this, and I'll explain it all to you in a sec, was a thing called the non-farm payrolls, which is, again, as it sounds, it is the payrolls of the non-farm, the non-agricultural sector of the United States. And it is basically a figure that comes out normally on the last Friday of every month. And it tells you how many jobs were created in the United States or how many jobs were lost. And just to give you a bit of background, on average, over the last about 10 or 11 months, the United States economy has created about 250,000 jobs per month. On Friday, it created only 115,000. So clearly, the American economy, or at least the employment figures, are telling us somewhere about where the economy is going. So that's what we're doing. How are you, Head? I believe you have abandoned your necklace of onions, your stripy T-shirt, your baguette, your Jacques Brel back catalogue.
I have indeed. Well, unfortunately, I'm back because France, as I was saying before, was amazing, but it was so hot. It was up at 39 degrees, 40 degrees. I found myself getting up at 6 o'clock in the morning. Now, you know me, Mac. I never see that hour of the day, ever, unless I'm on a rollover.
Exactly, of which you are, but you maybe less so now. But over the long haul of our friendship, I have seen you on one or two rollovers. That's fair. That must be true.
Well, the French rollover is slightly different. So I was getting up early in the morning.
That sounds like a weird sexual position, John. Actually, a French rollover. Tell me more. My innocent ears.
Don't worry, Mac. I'll send you pictures. Anyway, but come here. Like just when I came back, something struck me about an article I was reading about. You mentioned stocks and Intel and all that kind of stuff. And a few episodes ago, we spoke about Ireland's economy being so dependent on the multinationals, the Intels and the Pfizers and all those guys. But it seems that, Intel's stock has dropped 30% almost overnight in the last few days.
Yeah.
Is that worrying for the Irish economy? And then I was reading further that there's a huge kind of global stock market sell-off. So
yes,
what's going on? I know you mentioned the job figures in the States, but as well as that, there's supposed to be inflation is down in the States and the economy, by all accounts, was doing okay. So why is this happening? What's going on? And should we be worried, more to the point?
All right. So what I've always argued is, and I explain this to Americans when I go over there to give talks and what have you, is that the Irish economy, if you try to understand it, is basically Connecticut with shitty weather. Right. And by that I mean that the Irish economy is an adjunct of the United States economy in the multinational sector. So there's no other society that is so wedded at the hip, joined at the hip, umbilically, let's say. That's a lot of metaphors there. We'll go for umbilically to the United States economy via the importance of and commitment of multinationals. So that's the first thing. And that's why the American economy is so important for us, because corporate America makes decisions that have a massively amplified impact on not just Irish employment, but Irish taxation.
Yeah.
Because Intel, although they don't publish the figures on a specific company by company basis, Intel is probably one of the top 5 taxpayers, corporate taxpayers in Ireland, right?
For sure,
So
yeah.
this is
Absolutely.
so this is very, very important. It also employs a lot of engineers. It also employs, I think, about 6,000 people. So if they're going to cut a workforce by 15% worldwide, what you can see in and around the Leixlip area is a significant drop in employment, i.e. hundreds of layoffs in Intel. So for those people, this is hugely important as well.
Yeah.
But when you actually take a little bit of altitude from it, John, what I'm trying to figure out is, are the problems in Intel specific? So Intel has had a huge change of management, change of chief executive, change of strategy over the last 4 or 5 quarters.
Yeah.
Are they Intel specific, i.e. what they would call the turnaround plan of Intel? Because basically what happened is Intel has invested a huge amount. You'll see, I think there was a Fab 24 was the latest fab built in Leixlip. So they've put in a huge amount of investment. They've probably overinvested since the pandemic or since just before the pandemic. They now have excess capacity. They are trying to figure out what to do there. I'm not sure if the woes of Intel are Intel specific based on management decisions taken within Intel, which have not gone right, or it's sector specific, which is on the chip industry in general. It seems to me that the chip industry in general is not going through this sort of retrenchment that Intel is going through. So that's the first thing.
Is that because like Intel might be falling behind a little bit on the surge of AI, for instance, with NVIDIA? And
the way I would look at it is, it looks to me like Intel is to chips what Boeing is to the aircraft industry. So at the moment, there has never been a greater demand for planes worldwide because tourism and travel is back to pre-pandemic levels. However, the significant market leader in airplane making, Boeing, has had a disastrous time on the safety area. So what you find is that although the market in general from airlines is very, very buoyant, the problems specific to Boeing are actually specific to Boeing's management and the fact that it's just bad management. And I think this is exactly what's going on in Intel, which is basically, this is a company story, right? It's not a worldwide story. But your point about tech stocks is very valid. There has been a large, significant sell-off in tech stocks. And I think this is basically rooted in what we're about to talk about, which is 1, the valuations went so high. 2, very high valuations are incredibly sensitive to interest rates.
Yeah.
And 3, again, what you find in the tech world is, again, management just getting ahead of themselves and fantasizing about what the future is going to look like. And of course, then you get investors getting ahead of themselves, all this creating bubble conditions. And then if somebody says, well, don't worry, because the Fed is going to cut interest rates, and that will actually at least reduce your cost of capital. And if somebody says, well, maybe the Fed won't cut interest rates now, you get these wobbles. So this is it's all linked in.
But that sounds like it's just everything is kind of guesswork. I mean, companies like Intel or whatever, they do have to kind of sit down around a board table and decide on a strategy for the next year, 5 years, 10 years, 20 years, or whatever it is. And, you know, they have to pin their colors to the mast. So, you know, is there a case of either they misread what was coming down the line, or it was just kind of they were overtaken by the rapid development of AI, and they're like, no, I'm not just AI, but you know what I mean?
I'm not so sure. I mean, the world is full of really good companies that go bad. Okay, that's the first thing.
Yeah.
And the world is full of chief executives who actually end up being revealed having feet of clay, that they aren't the geniuses that they think they are, right?
Yeah.
And in a hagiography world of the sort of the Davos strutting chief executive who gives long speeches about climate change, you know, to his peers, or it's usually his peers, that's, as I always said, it's a great sell signal. When a chief executive gets up at Davos and talks about climate change, just sell the company.
Right.
Just run away.
It's stuff they shouldn't be talking about. Is that what you mean?
No, it just means that they've got a messiah complex, right?
Right, okay.
And basically, at the end of the day, your job is to look at the P&L to make sure that you keep your costs under your expenses, you keep growing market share, and ultimately make a bit of profit. That's your job. Your job isn't to tell me what you think is going to be the global temperature in 2049, because frankly, I don't care what you think. because you don't know. Okay,
That's fair enough. Okay, yeah.
But let's broaden it out, John, because I want to talk about the American economy itself. And I want to talk about the Federal Reserve, because the Federal Reserve sets the most important price in the financial world, which is the rate of interest. Because the rate of interest is the price of money. And the Federal Reserve sets the price of money in the United States. It therefore sets the parameters for the long bond in the United States, which is the 10 or 30-year rate of interest, the 10-year rate of interest, and then from that, the 30-year rate of interest, which is in effect the mortgage rate.
Yeah.
Now, just a little bit of analysis here. Because the Fed prints money and has the exclusive mandate to print dollars, it is what we call a monopolist. It is in a monopoly position. There is no competition. There's nobody else printing dollars, right?
Yeah.
And in economics, there is one iron law of monopoly, which is the following, that the monopolist can set the price, but not the quantity. So they can't set both.
Explain that a little bit more.
So, for example, if you are a monopoly provider, I don't know, of bicycles, right? And you're the only bicycle manufacturer in the world.
Yeah.
For some reason, bicycles came to mind.
Okay.
And but don't worry, I'm not going down the mammal route.
Please don't.
So you set the price of bikes. Now you say, okay, every bike is, I don't know, let's say 500 euros, right? You can set the price, but you cannot determine how the market will react to that, the quantity of bikes demanded at that price. And it's actually the same for money. The Federal Reserve sets the price of money, so it's the rate of interest. So you might say, okay, the rate of interest is 5%. It has no idea, in effect, how much demand for money will be created by that price. It's hoping it has an idea, but it can't set the quantity. So all it can do is set the price or the quantity, but not both. That's one of the iron laws of market economics when it comes to monopolies. And a good way to look at central banks is they are the monopoly issuer of currency in their jurisdiction.
Right.
So
okay.
The reason this is all important is the price of American money sets the price of global money. And in a time when there is a huge amount of leverage, huge amount of borrowing in effect, what the price of money will do, it at the margin, it will determine the efficacy of investments, because most investments are, you borrow money to invest against an idea in the future that you hope is going to turn out well. So obviously the price of money has a crucial impact on the efficacy of that decision. So when interest rates are low, every decision looks great because money costs nothing.
Yeah.
So there's no real way of actually explaining, there's no real way of evaluating anything when interest rates are zero. In fact, as I always say, basically when interest rates are zero, you're just looking for the fellow with the best story, with the best yarn.
Yes. Yeah.
Right? But when interest rates are high, you can use that to what we call discount investments, right? So you divide your lots of your investment, lots of your ideas by the rate of interest. So that's it. So that's what the Fed is doing. Now, the fascinating thing, this is the key thing, John. Given the absolutely essential nature of this to the global economy, and there are 12 people on the board of the Fed, 12 wise men and women, you would hope that there is some rigor, intellectual, mathematical, even, dare I say, statistical rigor to the decision-making process.
Yeah.
But the funny little secret is there isn't, okay? That in a way, basically, because the future of the economy is unknown, because you cannot determine where the economy is going to go in any absolutely precise way, you're basically making a guess, right?
Yeah.
So the interesting thing is the Federal Reserve is making a guess, and the markets are guessing what the original guess makers are guessing.
But then also the Fed guys, the 12 wise men and women, are guessing based on what's going on in the market. So it's like a feedback loop. So nobody knows what the fuck is going on.
No. It's based on what's going on in the economy, right? So I was reading, John, today about the fall of the Assyrian Empire. Okay, don't ask me why. Okay, it's just something I've got into.
I'm just going to roll with this one.
Yeah,
French
yeah,
roll
yeah.
with this one.
Yeah, you're going to French roll with this one and see what happens, right? So the Assyrian Empire, massive empire, kind of wedged between the Sumerians and the Babylonians and
Yeah,
Egyptians, all that sort of carry on, right? Fascinating place. But they were, like the Sumerians and all the ancients, inveterate stargazers. And the reason I was interested in this is because I am, as you know, down in Croatia.
Yes.
And this time of the year in Croatia, what happens is the skies are incredibly dark here because there's no light pollution because we're out on an island, right?
Yeah, beautiful. I love that.
And they're very, very clear. So around this week and next week, we get an extraordinary profusion of shooting stars.
Yes,
right?
It's the Pleiades season.
There you go. So imagine that the Pleiades season and inject that into economics, right? So I will be looking at shooting stars, and therefore I was looking at the history of shooting stars and astronomy. And I came across the Assyrians.
Just sit back and enjoy them, will you?
No, I came across the Assyrians who were stargazers. They loved sitting up watching the stars. And why were they stargazers? Because they were looking for, there was one part of them looking for signals from the gods and portents and all that sort of stuff. Yeah. But there was another much more material side to their stargazing, which is they were looking for cycles, for repetitive cycles.
Okay.
Right? So that they could actually figure out how many days were in the year. So they could figure out where the seasons were. So they could figure out, all this sort of thing. So one part was kind of hocus pocus, which a lot of economics is, by the way.
Yes.
And the other side was they were looking for repetitive patterns which would allow them predict the future, which would allow them predict harvests, all that sort of stuff. This is how they based their calendar around the number 60. And this is why we still have 60 minutes in an hour, 60 seconds in an
Comes from the Assyrians.
It comes from the Assyrians, took it from the Sumerians, but all that part, those geezers, right? And it was all based on astronomy. But I don't think there's much difference between the Federal Reserve and the Assyrian stargazers. This is what I'm saying. So this Federal Reserve look at data and they try to look at patterns in the data. And when I was working in a bank as an economist, that's what I did. You try to find patterns in the data which give you either leading, lagging, or current indicators as to where the economy is. And I explain all that, right? And this is the hocus pocus of interest rate forecasting.
Yeah.
Now, you might think this is slightly esoteric, but in fact it's not, because so much of the betting in financial markets, the financing of companies, the refinancing of investments is all based on interest rates. So if you can actually get a march or steal a march on the next guy as to your ability to predict the interest rates, being in effect a 21st century stargazer looking at data from the economy, you actually get a competitive advantage. So that's why when I was working in that business, you spend a huge amount of time basically looking at what I would call the entrails of the economy. In the same way as they used to look at the giblets and the entrails of a rabbit. To see whether it was right. Okay, so you look at the entrails of the economy. And what happens is the Fed is now looking at the entrails of the economy. Why is that? It is because the Fed has a dual mandate. One mandate is to try and maximize the rate of employment in the United States.
Yeah.
And the other one is the rate of employment consistent with a rate of inflation of 2%. So there's this idea, when we talked about the Phillips curve before, this idea of a trade-off between inflation and unemployment, right? So at the moment, American inflation has fallen dramatically from around 9% just around the end of the pandemic, which was a supply chain thing, etc., all the way down to towards 2%.
Yeah.
And they have what's called a last mile difficulty. And by that, I mean, it's quite easy to get the rate of inflation down from 9 to 3, because usually that was as a result of a shock to the system, which actually tends to wear out. But it's very, very hard to get inflation from, let's say, 4%, 3% down to 2%.
Okay. Why is that?
That's because it becomes ingrained in the system. Inflation, so workers' expectations. Like, hold on a second. If I don't get a 9% pay rise, I will actually lose in real terms, my real wages will fall. So what you find is that it just takes that little bit of time to get inflation right down to where you want it to go. And the key for the Fed is, because it has this dual mandate, it's always saying, well, we could crush inflation, but we would then set unemployment rising rapidly. And our mandate is to maximize employment and to minimize inflation. So they're always trying to do this one thing. So
it's a fine balancing act,
It's a very fine balancing act. that only the Americans are concerned about. All other central bankers are only concerned about inflation. And they just say, well, the economy can, do whatever it wants to do.
Yeah.
But the Americans have a much more democratic mandate, which is to look after the real economy. So all of this is going on. And these are the sort of permutations that our friend, Mr. Jay Powell, is trying to figure out. And of course, one of the big figures that they all depend on is how many jobs are being created.
Yeah.
And if there are loads of jobs created, that means the economy is flying along. That means they don't necessarily have to cut interest rates. Now, remember, American interest rates are very high at the moment. They're 5%, right? They're hovering around there. Now, that means mortgage rates could be up as high as 7 or 8% in the United States, right? So these are historically very, very high figures for the Americans. Despite this, the economy is zooming along, whereas the typical person looks at inflation and looks at unemployment, etc. Real stargazers, real entrail examiners look at other data.
Just to interrupt you there, Mark, I'm hearing that bell behind you. It's like the stock market bell. You're very young.
Well, John, you see, this is a very Catholic country, Croatia, and the bells of the church, which is just right beside us now. It's midday, and they're calling the faithful to prayer.
You better go then, Mac.
I've tell you, I better go. It's one of the very few places that I've seen nuns. You know the way nuns kind of disappeared in Ireland, right?
Yeah,
it'd be very hard to find them. Yeah, but not here. They're resplendent, all in the full habits, walking around. But so let's just bring it back to the numbers, John.
Yeah.
So yes, you can look at the broad numbers of unemployment and these sort of things, but that doesn't give you a real edge. So what you do is you go very, very deep. Now, the extraordinary thing about the Americans is they are brilliant at statistics. They have longitudinal studies which go back for ages. They basically report on everything.
Yeah.
It's an amazing country for that. And that's why it is, for an economist, a sort of a nirvana, because it is full of data. So a thing that I used to look at years ago, John, was the daily data from restaurant bookings.
Okay.
So isn't this amazing that in the States you can get daily data on the amount of people who are booking restaurant tables?
Yeah.
Which is a phenomenal idea. So if you think that you can get data on real-time restaurant bookings, and if you think that restaurant bookings are a very good indicator of the buoyancy of the consumer, if people stop going to restaurants, what they are worried about is their future pay packet, their present pay packet, what you would call the cost of living crisis, etc. Because typically you don't go to restaurants unless you've got a few quid in your pocket. And again, they have been holding very, very steady in the United States, okay, over the last year or so. Another great indicator from the Americans is to look at the daily data for US air travel.
Okay.
Because Americans fly all the time. Now, again, if you were of the environmental perspective, you would say this is a significant indicator of the end of humanity and the end of a civilization. And clearly we're going to get more and more forest fires and global warming because the Americans fly all the time. But let's just be that as it may, as an indicator, you can again get data, real-time data in the States on how many seats are being booked on flights every single day. And that gives you, again, two ideas. One is it shows the amount of which Americans are traveling within the United States. And that is a very good proxy for business travel.
Yeah,
okay?
Yeah.
That's the
Makes
first
sense.
And the second one is just, general, I'm going to go and see my mother in Minnesota, even though I live in New York. And I feel that I have enough money in my back pocket to do so. Or I'm going to go to Florida on holidays or whatever it happens to be.
Yeah.
So that's a really, really good leading indicator if you're into all this stuff. And then, of course, retail sales, right? Retail sales, again, weekly data for retail sales in the States, which is matches exactly what the Americans are spending their money on. So you can see that if you go really, really deep into it, you can look at things like global jet fuel demand, right?
Yeah.
Again, you can get figures on this every week, how much airlines are buying. Of course, you've got credit card data on defaults and credit cards. You've got bankruptcy filings, right? You've got bank lending. You've hotel occupancy rate. This is a really interesting one, John. So what you do is you take all that stuff, John, you just force feed it into a big econometric model.
Yeah.
And what comes out of the far side should be indicators of where the economy is. Now, they would be what I would call current indicators, right? So they're saying, okay, That's where we are now.
Yeah.
Another part of the stargazing is what's called leading indicators, John. And leading indicators are survey data, right? And again, the United States is extraordinary in this because the United States, the Bureau of Statistics have thousands of statisticians who go out every single week, who used to go out, now it's more done online, asking businesses what they think is about to happen.
Right.
Are you planning to introduce more workers? Are you planning to invest? Et cetera, et cetera. And they're leading indicators. So what they're telling you is much more people's perceptions of where the economy is likely to be in 3 or 4 or 5 months' time. So again, you take those together. And then what you do is you weight all these for significance in the economy. So what sectors are most significant? So for example, at the moment in the United States, construction of new factories in manufacturing is going through the roof. This has been, I would say, the most extraordinary piece of data in the United States. That's all to do with Joe Biden's Build Back Better.
Yeah.
That the Americans are building more manufacturing plants than we have seen in decades. So that side of the economy is incredibly strong. So John, you take all that stuff together, and then what do? You just make a guess. This is the funny thing.
But actually, yeah, you make that guess. But I go back to the point I was making earlier, that those business leaders are making their decisions on the research and the stats that the Fed and the statisticians are producing, having spoken to the business leaders. So they're reading their own research. It's this kind of...
It's reading your own tea leaves, John.
Exactly.
Did your auntie ever read your tea leaves in your cup of tea?
Yeah. It was always bad news for me. Always.
It's funny, I had an auntie, Pat, who was a really nice person, but when it came to the tea leaves, I was only about 8 years old. She was always apocalyptic, Armageddon. And I'd be like, oh my God, what's going to happen? Okay, we'll talk to you in a sec after these.
Okay, Mark, you were explaining there how the Fed gathers all its information and stats and researches the economy and the markets and what people are doing and all that. That's fine. So you have all that. Then what happens? And how consequential is all this?
So all this is fed into the research notes that are given to the wise men and women at the Fed board. And they then vote on it's an election. Should we raise our interest rates or should we not? I mean, this is, John, this is a half an hour lesson on monetary policy and how the black arts, the dark arts of monetary policy are executed.
Yeah.
And what you will find is some Fed members are hawkish, which is basically they are much more jaundiced towards or biased towards bringing inflation down.
Yeah.
And others are what they call dovish, who are much more likely to be concerned about the rate of unemployment, the economy in general. So what I would say is there is absolutely no clarity as to where the United States economy is going at the moment. Looking at all that data, there's an enormous amount of positive, bullish, upbeat, optimistic data, as I've cited there. However, the rate of unemployment is beginning to tick upwards. And the rate of unemployment is beginning to tick upwards primarily because Americans have probably become more productive. So they don't need as many workers to generate this type of buoyancy in the economy.
Okay.
Now, but the problem is the rate of unemployment rises. If it rises in sensitive swing states that we're all talking about at the moment, John, that will give a perception to the Republicans, and it'll give them ammunition to say, look, Joe Biden spent all this money on the economy. We're running massive fiscal deficits. That's why the economy's roaring ahead. And even still, the rate of unemployment in our neighborhood is beginning to fall. So typically what happens, if you're not in an election year, these are issues that are really important for just like finance guys or people who are making investments in the economy, or political commentators, etc., right? And financial market commentators and that sort of stuff. Traders, bond traders, currency traders. But in an election year, these things are material because each side is going to pick up on good news and say, look at this, aren't we great? And the other side is going to pick up bad news and say, look at these, aren't those guys idiots? So this is why right at the moment, it is incredibly finely balanced between the good data, which is suggesting the economy is quite robust, and every now and then signals from the labor market suggesting the economy could be quite weak.
And then if you feed into that, this global stock market sell-off, like
Yeah.
is that's feeding off the same data and information?
Well, the global stock market sell-off is a function of the fact that there was a perception a couple of months ago that the American economy was going to weaken and that interest rates were going to come down. And what has happened is, as it's happened in the last couple of years, the economy kind of refuses to lie down in the face of very, very high rates of interest.
Yeah.
And therefore, those bets, those short-term bets on technology stocks that were taken are reversed. A lot of the stuff, okay, is basically if you take out the top 5 or 6 or 7 American tech companies from the American stock market, what you have is a very underwhelming performance. So a massive preponderance of money has gone into tech, driven in the main by AI.
Yeah.
This perception that AI is going to change the world. And now I think there's a lot of people saying, I'm not sure, is this just sort of a kind of a fast version of a Google search? You know, actually, is it going to change the world?
Yeah.
So a lot of those companies that were, even in March, April, May, regarded as bets on the future, people are saying, not so sure. So basically, it's the up and down.
But this could be quite good news, though, in many ways, because if they're disinvesting, if that's the word.
Oh, John, you could get a job as an economist.
From the tech stocks, where does the money go? Does it go back into other traditional manufacturing and more traditional kind of companies?
Well, you know, you'd like to think that there's actually a set pot of money and it goes, when it goes from X, it goes to Y. But just think about what happens is when stock markets fall, people lose money.
Yeah.
And if that money is borrowed, they have to pay that money back on margin or leverage. So in a lot of ways, what happens is, and it's a very strange thing to think, the money kind of disappears. So it's not as if they're taking money out of X and into Y in a rational way. Typically what's happening is when you
sell off, you get some of your cash back.
Well, the thing is, if you sell off, you get some of your cash back, but you get less than you put in the first place.
Yeah.
So you're kind of a little.
When you sell, I suppose.
Yeah, yeah. So what I would look at more as, you know, what is happening now is you've had a massive run up in tech stocks, right? And some people are taking profits. Some people are freaking out. Some people who will have been in that game for a few years now are taking huge profits. Others who've just got in the last couple of months are taking huge losses. So it's a matter of how that actually winds down. But to come back to the Fed will look at the stock market sell-off, and this will suggest to them that the wealth effect from stocks will be less in the future. So this will suggest to them the economy will be weaker in the future, consumer spending will be weaker, and this tech sell-off will increase the likelihood of a cut in interest rates.
Right.
So this is the way in which the world works. It's a bit like there are so many variables at play. You have to keep juggling things up in your head and see, does that offset this? Does this offset that? This is the whole idea of economic forecasting, which is why it should be quite a difficult thing to do. But if we come back to the basic idea, is that the Fed is only as potent as the data it has. And the data it has is only as good as the precision of the data, which is why you have to go very, very deep into the data to gain any sort of real insight into what's happening, which is why there are legions of economists employed, John, all over the world, looking at all the entrails, which is why, to go back to our friends, the Assyrians, they are basically the 21st century version of the high priests in the Assyrian temple, who you'd be looking at the giblets of a chicken on the one hand, and, as you'd say, the course of the stars, like Sean O'Casey, the plough and the stars on the other hand. And that, in effect, John, I know it's going to sound weird, is what macroeconomic forecasting is all about.